this video, we're going to look at Firon Technology. This is an aerospace and defense company located in Toronto, Ontario. And what I do in my videos is I try to figure out the real stock price of the company using their prior financial information. And then we look at the financial ratios. And we also compare those to companies in the same industry. And I'll do this with you step by step so you can see the process as if you're doing it with me. So let's get started with the model. This company has a market cap of $39.8 million. It's a tiny company. I generally don't like to invest in companies under 1 billion market cap. It tends to be a little risky. They're trading at $1.75. So that's one share, $1.75. Let's pull the free cash flow, and this is the cash that's remaining after business pays its expenses. So I'm going to pull that for 4 years. And sometimes there could be negative free cash flow, and that doesn't necessarily mean they're spending more on their day-to-day business. They just might be investing, like buying new machinery. Let's pull the net income. This is the profit and loss according to the income statement. And then we're going to pull the revenue, which are the sales for each year. So here's the numbers I just entered, also the net income margins. And they do have 2 years of negative free cash flow. So it makes it a little difficult to value a company if they don't have positive numbers. Let's get their interest expense. They pay $521,000 of interest on their debt. And now let's figure out how much debt they have. We'll go to the balance sheet. Then we'll go to the liability section. And current debt of $2 million. That's debt due within 1 year. And then long-term debt of $5 million. That's debt due after 1 year. They pay 7% interest on their debt. They're a smaller company, so they probably don't get as good terms as a larger company. So that's why they pay such a high interest rate. So interest payments are tax deductible. Let's get their effective tax rate. So they have $10 million of income before tax and $4 million of taxes. So the cost of debt is 4.4%. And to get the cost of equity, we need the beta, and that's how volatile the stock is relative to the market. And they have a beta of 1.3, so the stock moves a little more than the market does as a whole. So it's not too volatile. We need to pull their current assets from their balance sheet. We need this for the ratios we're going to look at later. So the current assets are $50 million. Those are assets that include cash, accounts receivables, and inventory. And current liabilities, these are debts and payables that are due within 1 year, and that's $21 million. And the equity is the value of the company according to the balance sheet. It's assets minus liabilities, and that's $41 million. And their EBIT, earnings before interest and taxes, and in 2019 that was $7 million. They call that operating income on the income statement. The cost of debt is 4.4%, and they have 15% of debt in their capital structure. The cost of equity is 12.3%, and we use the capital asset pricing model to figure that out. The weight of equity is 85%. So the weighted average cost of capital is a blend of the cost of debt and the cost of equity, which is 11%, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today's values, and we get a value for the entire company of $228 million. And we divide that by 23 million shares, and we get a stock price of $10.03. It's actually trading at $1.75, so it's trading at an 83% discount, so it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're at $7.19, so they're also saying it's a buy, a little less than what I value them at. But like I said, it's really hard to value these small companies. It's hard to value any company, to be honest, but it's really a guessing game with these really small companies. The stock was trading at pretty close to $5 at a couple of points the past few years. It's come down quite a bit. So the stock price is based off of investors' sentiments of the market and how they feel the future of the company is going to be. The market is forward-looking, so people don't generally invest how a company has done in the past. They look to the future of a company and try to estimate how it's going to do. And that's what stock prices generally indicate, is how people feel the sentiment of the future of the company. So investors just don't feel comfortable paying $10 or even $5 anymore. They're willing to pay $1.75 at this point. It may come up in price, that remains to be seen. Let's look at their financial ratios. They have a great PE of 5.9, that's price to stock over earnings per share. Really good price to sales, that's price to stock over sales per share. And that's 0.4, so that means that investors are willing to pay 40 cents for $1 of sales. They also have a good price to book of 1.0. This implies that if a company liquidated its assets and turned it into cash and used that cash to pay off all its liabilities, there will be enough money left over to give each shareholder their $1.75 back. So you may be thinking, why would I invest in a company to just get my investment back? Obviously, that's not the idea of investing, but if the balance sheet is strong enough where it could pay back all its investors in a whole, there's not much risk in investing in the company. They have a current ratio of 2.3. That's okay. They can cover their current liabilities, no problem. ROE is 16%. That's income over equity. That's decent. Interest coverage ratio 13.8. They can easily cover their interest payments, and only 15% of debt. The best way to look at a company's ratios is to compare them to similar companies. So I've done videos on Boeing, Airbus, General Dynamics, Raytheon, and Spirit. FTG is the only Canadian company, but you can compare the ratios. You just can't compare the market cap because that's in the home country's currency. And FTG is right here, and if the number is in green, they're better than the average, and if it's in red, they're worse than the average. So they're better than the average company in price to earnings, price to sales, price to book, and current ratio. They're a little worse in ROE. The average in the industry is 18% and they're 16%. And in debt, they're the best. They have the lowest amount of debt. Boeing is all debt. So even if you converted this 40 million Canadian dollars to US dollars, they're still by far the smallest company. So let me know what you think of the video. Thanks for watching.